Good morning. I'm Jennifer Zabasaja, and you're watching Africa Amplified, Bloomberg's monthly show bringing Africa's stories to the world. This month, we're putting the spotlight on soft commodities and one of the continent's most important cash crops, cocoa. As you can see right there, the future of cocoa is under threat with record-breaking prices and chronic supply shortages rattling the market and set to push up global chocolate prices for a number of consumers. We're also going to tell you why similar factors are affecting Southern Africa's most popular staple and how this could lead to the smallest corn harvest in South Africa in 5 years. But first, let's dive into the stories and issues on the agenda affecting the markets with our reporters from across the continent. We're going to take you to Dakar in the west and Kigali in the east. But let's start here in Johannesburg as we build up to what's expected to be South Africa's most hotly contested democratic elections. We've been spending the past few weeks speaking with business leaders to gauge their views ahead of the May 29th vote. Here is some of their sound.
What will drive investor sentiment is a level of stability in the ability to implement and execute on policy and a stable coalition environment.
Coalition governments will at the very least mean a change of direction.
If the country continues to implement its plans on electricity, logistics, crime, corruption, one could see growth faster than 1.2% in the medium term.
So there's a lot of expectation for the election. And the country is resilient, and often I would say the narrative is a lot worse than the reality.
All right, so those were some of the business leaders we've been speaking to. While analysts expect a coalition government, we've also been speaking to South Africa's two biggest parties, and they're telling us it may not be so simple. Take a listen.
Yeah, when you do strategic planning,
right.
You never work on the basis of your worst case scenario.
Right.
Okay.
Is there a consideration, though, considering what we're seeing from the DA, from the MK, from all of these other smaller parties, is there a preferred outcome outside of the majority?
Our experience is that in South Africa, society is not ready for coalition. They don't work in local government where they've started. Everywhere it collapsed. I'm staying in Pretoria. There's a coalition there led by the DA for 8 years. I have no water there for 2 days now. 2 days, I don't have water. And I blame half DA because it is leading, but it shows the dysfunctionality of coalitions. We are not ready for it. We are not in Sweden. We are not in the Nordic countries.
So then what would that mean for South Africa if there were to be a coalition government voted into office?
There will be a coalition if it is there, but I know that is not optimally working. We've seen it in local government.
Right. So you don't think it would work at a national level?
It will not work because they will change a president every 2 months and change a minister every 1 month. And that doesn't work in real life.
My job is to get the ANC out of government. I don't think we're going to solve the country's problems by having the same people who are responsible for the economic crisis, the social crisis, and the infrastructure crisis sitting around the table. We've got to change them. And that's why the multi-party charter has said we will not do deals with the ANC or the EFF.
What if we see a scenario where the ANC still is somewhat in the majority? Is the DA going to rule out working
We will
with
go back to the multi-party charter and we will decide on what the best option for it. It may be a minority. Maybe we could form a minority government as a multi-party charter. I just think there's too many unknowns at this stage to say my focus is on getting the ANC way below 50% and getting a new set of people around the table so we can get our country off this low growth, high debt, high unemployment trajectory.
And don't miss our next episode of Africa Amplified, which will be a South African election preview special. That is, of course, on the first Friday of the month, May 3rd for next month. All right, let's stick with the elections theme, though, for this month's episode. And Senegal's new president has named populist opposition leader Ousmane Sonko as prime minister. The appointment came just hours after Bassirou Diomaye Faye was sworn in as president following his landslide victory over the ruling party candidate in the March 24th ballot. Sonko's expected to name a government in the coming days. Luckily for us, we have Bloomberg's Katarina Hojayi, who's been following events, and she's joining us from Dakar. So, Katarina, thank you so much for getting up with us. So, based on Faye's first public announcement, I mean, what should we expect from the new president? This was really highly surprising how quickly this election happened.
Indeed, I mean, Faye's win in the first round over the ruling party candidate was unexpected. And now he's taking over an economy that's growing at a slower pace than in past years, just over 4% last year compared to an average of 5%. There's widespread frustration among Senegalese over lack of jobs and high living costs, pushing some young Senegalese to seek better opportunities elsewhere, often on fatal journeys by boat trying to reach Europe. And Faye's immediate concerns will be addressing those grievances, which are also the same issues that swept him to power. He's expected to follow through on a promise to renegotiate deals with Senegal's partners for the exploration of offshore oil and gas. And finally, he signaled he will be keeping a close eye on Senegal's expanding debt stock. The country is at moderate risk of distress, but public debt is still estimated at over 70% of GDP. So considering Senegal's needs, official unemployment is currently at over 20%, is likely much higher, and 1/3 of population of 18 million lives in poverty. The grace period for Faye's administration will be quite short.
Very short. And I mean, especially when you consider, Katarina, what we saw from the markets in reaction to this quick election. I mean, in terms of investors, what do you think is really the key focus for them moving forward in this new administration?
Faye has already sought to reassure investors that Senegal will respect its commitment to its partners and that their rights will be protected. That said, Faye's focus will be on Senegal's interests. In his first major policy announcement on Wednesday, he called an audit of the oil, gas and mining sectors. He's also expected to favor the Senegalese private sector, while international partners could be asked to contribute more to developing the country. Faye wants to build a local industry, transforming more of the country's resources in Senegal as opposed to exporting raw materials. What he likely won't do is interfere with the time plan for gas projects that has already seen multiple delays. First gas from a 4.8 billion gas field offshore being developed by BP and Cosmos is expected later this year, and part of that revenue is already baked into the budget for 2024, with IMF hinging growth of 8% this year and double digits next year on that project starting on time.
Wow, and we know you've been following this very closely, so appreciate you getting up early for us. Bloomberg's Katarina Hojayi in Dakar for us. Katarina, thanks so much for waking up. All right, let's turn from politics to debt now, even though, of course, they are interrelated, as we just talked about. And Zambia says it's close to reaching restructuring deals with some of its remaining commercial creditors. It became the continent's first pandemic-era defaulter in 2020. So let's bring in Bloomberg's Andira Oganga, who's been following the story for us from Kigali. So, Andira, tell us about the debt deals Zambia has struck. This is significant.
Well, Jen, they have reached an agreement with some of their lenders to revamp $6.3 billion as part of their larger $10.1 billion that they owe to some of their creditors. They reached a preliminary agreement in June, signed a memorandum of understanding in October, and the last two signatories, which are China and India, put ink to paper in February. Of the remaining $3.3 billion, the National Treasury says that negotiations have begun on some, while others are almost getting there. If we zoom in on Eurobonds, they owed $3 billion, but because they defaulted, interest have accrued, and now the loan stands at about $3.89 billion. They reached an agreement with some of the investors to write off $840 million. So even though the Group of 20 common debt framework has been criticized as too slow and almost painful by the president of Zambia, the country is now beginning to make headway.
Yeah, it's been very interesting to see sort of this back and forth for Zambia. But, you know, they're not the only country that's really dealing with this, that's either defaulted or in debt distress, and therefore is looking to the common framework. I mean, can you talk us through some of the other countries that could potentially follow?
The most recent defaulter is Ethiopia, and they defaulted in December. And following this default, they were to reach a staff-level agreement with IMF in March, but they did not do that. And so the Paris Club extended them an extra 3 months to reach a preliminary deal with the IMF. And so between now and that time, we're going to see Ethiopia having conversations with the IMF on how to raise money, how to spend money, how to finance the $11.4 $4 billion gap. And in between that time, a lot will be happening. IMF's money does not come for free. It comes with conditionalities. We are likely to see them being asked to scrap off subsidies and also liberalize their FX market. The birr is currently overvalued in the official market and valued at half the price in the parallel market. So this is the changes that we're likely to see in Ethiopia. In the meantime, people are contending with an economy that is really, really hard.
Absolutely. Thanks so much, Ndiro Aganga, for always following this story for us in Kigali for us. Thanks, Ndiro. All right, coming up, cocoa prices trading at near historic highs. We're going to discuss how it impacts producers in Africa and consumers of chocolate across the world. Bad weather and crop disease in West Africa have impacted already aging cocoa trees, decimating harvests. Ivory Coast, the world's top cocoa producer, now expects output to slump around 25% this season. In neighboring Ghana, the second largest grower, bean output is set to drop by 35% compared with the last season. And in both countries, cocoa processing plants are facing shortages, and some run the risk of shutting down. Barry Callebaut, the world's largest bulk chocolate maker, expects the global deficit to continue, while manufacturers Hershey and Cadbury have warned of higher prices for consumers. With chocolate makers scouring for supply, the cost of beans has more than doubled in less than 3 months. In March, cocoa futures surged above $10,000 per ton for the first time. Yet farmers have struggled to benefit from these record prices, even after winning a higher pay deal. That's because West African growers are paid set prices imposed by tight government regulation. And even the economies of Ivory Coast and Ghana won't benefit, as they sell most of their crop a year before the harvest starts. They could potentially sell at current prices on the spot market, but they've run out of stock amid the surging demand. New European Union rules banning imports of beans grown on deforested land also risks limiting output even more. All of this means a meltdown in the chocolate market could be looming unless there are long-term structural changes in place. That's right. And cocoa expert Stephen Wattridge from Tropical Research Services says he's never seen anything like the recent moves in prices in over 4 decades of work. I asked him where he thinks the market is headed next.
We basically need significant demand destruction in order to bring the market back into equilibrium. And the problem in the cocoa market is that industry have significant forward price cover. So current prices won't be passed on to the consumer until later in the year. And basically, we need people to eat less chocolate.
Well, I feel like that is very unlikely that that's going to happen. But how then is this going to trickle down to the consumer?
Oh, we've seen chocolate prices rise in the last 12 to 18 months, ahead of inflation, but not massively so. I think over the next 12 months, we're going to see prices of chocolate confectionery increase much more significantly relative to other snack foods, who are the main competitors for confectionery. And that will instigate a change in consumer behavior, which is what we need.
And in addition to drought and disease ravaging West Africa's cocoa crops and sending prices upwards, traders and manufacturers are now looking at what impact EU deforestation regulations could have on exports into Europe. Just another thing to think about. So joining us for more is Bloomberg EMEA and Asia soft commodities reporter Mumbi Katau, who has, I think, one of the sweetest jobs in the company. But Mumbi, we can talk about that later. So Mumbi, can you run us through the details of the EUDR and really what the implications are for the industry?
Yeah, so EUDR is the European Deforestation Regulation. It's not a very new regulation. There has been talks about it, and it was adopted last year around June. Now it will come into force at the end of this year, December 30th. And what essentially that requires of any importer of cocoa into the EU is that they have to show that the cocoa that they're bringing into the bloc was not grown on deforested land. That has to be done starting next year. But I think the challenge for them is that they have to collect GPS coordinates or polygon maps for each and every farm that they want to bring cocoa from or source cocoa from. I think for regulators and, for traders who I've spoken to, the easiest way they put this is the objective of the regulation is to make sure that EU is not complicit when it comes to matters of deforestation. Cocoa has been in the news for bad rap over deforestation. There was a study, not as Bloomberg, but there was a study that was done between 2000 and 2020, and it showed that forests around the size of twice the size of London had been cleared between those periods. So the aim of this regulation is to make sure that deforestation doesn't continue. We've seen consumers who are more conscious and cautious about the kind of products that they consume. As a consumer, you don't want to have chocolate that is linked to deforestation. You don't want to have chocolate that is linked to child labor. So there's been immense pressure on the EU to make sure that it doesn't contribute to deforestation. For the last couple of years, according to Bloomberg research, EU alone has contributed to 7.5% of deforestation related to cocoa.
Wow. And Mumbi, we just heard from Stephen talking about how really the change that's needed is consumers need to consume less chocolate. But if we actually see this EUDR regulation go through, what's the impact then for consumers and for some of these commodity prices in Europe and elsewhere?
As we're already seeing that, so essentially cocoa is traded in two places, in New York and in London. And if you see in the last couple of months, prices that are in New York are much higher than prices in London are much higher than the prices in New York. So you can see already there's a price impact for cocoa that is traded in London. What that means is that it will be more expensive for consumers in Europe to satisfy that chocolate craze. So everyone loves chocolate, at least for me, I know I love chocolate. So it will just get more expensive as you go to satisfy that. And you've heard from Steve, these prices will come on in the next 12 months.
Yeah, and I know, Mumbi, luckily for you, you get to stay on this and hopefully buy more chocolate for us. So we might have to visit you soon. But Bloomberg's Mumbi Gatau in London. Thank you, Mumbi, so much for your reporting and your analysis this morning. All right, coming up, South Africa's corn harvest could be the smallest in 5 years as dry, hot weather damages the key crop at a crucial time. We're going to explore the implications for food security and inflation next. This is Bloomberg. And sticking with our story for today, it's not just cocoa seeing soaring prices. Hot, dry weather across South Africa's main summer crop-growing regions is hurting the outlook for key soft commodities. So joining us now in studio is Marlene Lowe. She is a senior agriculture economist at ABSA Agribusiness and has a new report out right now. So Marlene, thank you so much for joining us. So I want to start with what we saw in the report. Your team says we went from pandemic-era agricultural issues to even bigger mega trends that we're now seeing. Can you just walk us through a few of those?
Yeah, so I think the two main ones are climate and then obviously disruptions related to trade and the way we do business as a result of geopolitical tensions and factors related to politics. So in terms of climate, I think the story has been there around hot and dry conditions, which we've just seen in the cocoa segment. And then in terms of geopolitics, it's really around moving cargo between key markets. So the Suez Canal disruption, the Panama Canal disruptions, and how that affects the timing of products in markets, but also in a lot of cases, less products reaching certain markets.
Is it northern versus southern hemisphere that's having the issues, or are we seeing this happening even throughout the continent here?
Yeah, so in terms of climate, I think in 2023, we really saw a lot of climate records being shattered. And the southern hemisphere were relatively sheltered from that, given the La Nina conditions that prevailed. This year, the El Nino conditions have really driven the point home that we are dealing with a highly variable climate. And I think the intensity of the El Nino event just emphasizes that it's something that we need to keep in mind.
So then what are the biggest commodities then that are going to be affected that you and the team are looking at?
So for now, I think the main focus is on corn or maize. So in the southern African region, white maize specifically is a key staple. And what we've seen is that the market is currently pricing in that we'll probably need to rely on deep sea imports to service the southern hemisphere demand. We've seen Zambia closing markets, Zimbabwe, Malawi, and Zambia announcing a state of disaster. So we do foresee that there would be import requirements from those countries, which would need to be channeled through South Africa into those markets. The South African harvest is still projected to service our local demand, but regionally we will be short.
And you also talk about Egypt and citruses from Egypt, right?
Yes. So the issues in Egypt is disrupted by the geopolitical conditions in the Middle East. So the Suez Canal issues, I think, has bearing on where Egyptian citrus would go this season. Egypt has emerged as a major citrus exporter over the last couple of years, huge expansions in area. And I think traditionally this would have been spread across various markets. Given the disruptions in the Suez Canal, this might be concentrated more towards Europe this year because Far Eastern markets would be difficult to reach.
So really quickly, Marlene, before we go, if we're seeing more volumes entering the market, should consumers expect higher prices to continue for the foreseeable future?
Yeah, so I think price variability is the name of the game, given the uncertainty. We'll see how disruptions play out and how market windows are affected by these issues.
All right, but we went through a few of those, including cocoa and corn. Marlene, thank you so much. That's Marlene Lowe, the Senior Agriculture Economist at ABSA Agribusiness. Thank you so much. And that is all we have time for today. Join us again next month and every month if you can. From me, Jennifer Zabasaja, it's goodbye. Thanks so much for joining us.